As crypto continues to grow, so does the scrutiny from regulators around the world. Believe it or not, but these regulators appear to be working together at a global scale with the end game of controlling crypto. And one of the unelected and unaccountable organizations involved recently published a report about crypto. Today, we're going to summarize this report and tell you what it could mean for the crypto market. Stay tuned. The report we'll be summarizing today is titled, quote, Investor Education on Crypto Assets. It was published by the International Organization of Securities Commissions, or IOSCO, and we'll leave a link to the full report in the description if you want to come back and read it for yourself. Now, the report begins with a two-part summary, wherein the authors note that IOSCO is tasked with mitigating systemic risk in the markets and that it has been analyzing the crypto market since 2019. This implies that crypto could pose a systemic risk to the markets and must therefore be controlled. After noting a few of the crypto-related initiatives undertaken by the organization, the report's authors explain that the current report is a follow-up to a 2020 report which sought to examine retail investors in crypto. Whereas the 2020 report is based on 2019 data, the 2024 report is based on 2023 data. The authors then note that retail interest in crypto continues to climb despite the so-called crypto winter of 2022. And they also note that retail investors tend to get their info about the crypto market from social media. So if you're watching this video and you're a retail investor, congrats on being a statistic. Not surprisingly, the authors insist that crypto's retail investors require protection from all the frauds and scams that have plagued crypto, such as the implosion of Terra and the collapse of FTX. What is surprising, though, is that the authors believe education could be a solution, not just regulation. The catch is that the education these organizations have in mind amounts to indoctrination. And that's because the education they are thinking about focuses on, quote, comprehending the risks associated with crypto assets. In other words, it involves telling retail investors that crypto is very dangerous. It seems there would be little attention paid to the exponential rewards that come from investing in high-risk assets. It's easy to forget that even so-called safer cryptos like Bitcoin started off as very high risk. But early investors have been rewarded with gains exceeding 700,000 times. Bitcoin is the best performing asset of all time. And by the way, if you're enjoying this video so far, be sure to smash that like button to let us know, and subscribe to the channel and ping the notification bell as well to make sure you don't miss the next video too. Now, the third part of the report gives an overview of some key data points. The authors start by highlighting that there are a lot of crypto retail investors. Specifically, the data they gathered suggests that 6 to 10% of retail investors in more than half of the countries they surveyed are crypto investors. Not only that, but the percentage of retail investors who noted themselves as being very interested in crypto has skyrocketed compared to the previous survey. And this begs the question of why all these interested investors aren't aping in. Thankfully, the authors asked this question and got some answers. As you can see, the main reasons why retail investors stay away from crypto is because they don't understand it, because it's risky, because it's volatile, because there's a lack of regulation, and because of fraud. And it's in that order. But this is eye-opening, though, as a lack of understanding is the biggest reason of them all. And this underscores the importance of crypto education, which the authors also assessed. As expected, 80% of retail investors surveyed believe that crypto education is needed. At the same time, though, roughly 70% believe that crypto poses a significant threat to investors. It seems that the respondents are uneducated. Jokes aside, the authors also assessed why retail investors invest in crypto, and the answers are truly fascinating. The first is FOMO, which is obvious, but the second is less obvious, and that's because there's a low cost of entry. The third reason is because of advice from friends and social media. Nothing in this video is financial advice, by the way. In all seriousness, the low cost of entry factor is fascinating because it dovetails with the fact that most retail investors look at the price tag of a crypto when they invest, not the market cap, which actually determines the crypto's potential. Notably, this seems to be true regardless of the country surveyed. Interestingly, what seems to be more country-specific is the actual motivation. For instance, data about retail investors in Italy notes that the belief that money can be made quickly in crypto is part of the reason why investors invest in it. Just remember, though, that you can also lose money very quickly with crypto.
We regret to announce that the Bro Crypto podcast is sponsored by the Coin Bureau Deals page. This is the place where you can find the very best deals and promos in the crypto space. From trading fee discounts of up to 60% to sign-up bonuses of up to $100,000 on some of the best crypto exchanges. You'll also find crazy discounts on hardware wallets, and you can sign up for our exclusive Coin Bureau Club there too. So, check out the Coin Bureau Deals page today. Otherwise, you'll have to keep listening to these two idiots.
Hell, that's the problem a lot of crypto bros have these days. They're inside too much, 24/7 on the
computer. Open your inside. You need to get out. You need to get some sun. You need to get some vitamin D.
After an absurdly long overview of all the bad stuff that happened in crypto during the 2022 bear market, the authors finally reveal the education their constituents are giving to retail investors in the fourth part of the report. Naturally, a lot of this education has been happening via social media. Funnily enough, the authors point to meme coins as an example of how social media is driving cryptos to, quote, incredible market values. And if you watched our video about financial nihilism, however, you'll know that the reasons for this phenomenon go way deeper. Many see it as the only way to build wealth. Now, what's even funnier is that the authors don't actually provide any examples of how their constituents are using social media to educate investors. In fact, they almost seem to say this is because they don't understand social media algorithms well enough to do this kind of education. Fortunately, they don't call for social media algorithms to be adjusted so that their expert content is broadcast to retail investors. Unfortunately, some of the organization's constituents, such as the SEC, have already started trying to educate retail investors about crypto, and it's not going so well. You can look at the comment section of the SEC's crypto posts on X to understand why. As to why it's unfortunate, well, that's because anti-crypto regulators like the SEC have effectively discredited themselves with their antics against the industry. Any attempt they make to educate retail investors is therefore useless. It doesn't help that institutions more generally have discredited themselves. Nobody really trusts institutions anymore. And that's precisely why we're starting to see governments around the world crack down on so-called misinformation and disinformation. They're trying to restore trust in institutions by silencing dissent. But all that's doing is decreasing trust even further, causing governments to become even more controlling. Anyways, the authors seem to lament the fact that crypto is starting to rally again. They note that this is likely to suck retail investors back into the market, which is honestly good news. For context, there's been lots of FUD in crypto about whether retail investors will ever come back, and the authors of this report seem to disagree. In fact, they seem to believe that lots of retail investors will be returning to crypto. So much so that IOSCO has put together a strategy its constituents can use to dissuade retail from aping in. And they give a list of 6 talking points. The first of which is that crypto is incredibly risky and volatile. I mean, nothing new here. The second talking point is definitely a new one, and that's to be wary of so-called finfluencers, which presumably includes crypto YouTubers such as ourselves. The good news is that most of the worst finfluencers have discredited themselves, just like the SEC. The bad news is that new ones are emerging. Anyhow, the third talking point is a timeless classic, and that's that crypto doesn't come with the same investor protections as traditional assets. And this is a bit dishonest, as the only reason why crypto doesn't have these protections in most places is because the anti-crypto regulators refuse to provide clarity. The fourth talking point follows from the third, and that's that some crypto products do offer investor protections. And this seems to be a subtle reference to the spot Bitcoin and Ethereum ETFs in the US. And some would say this is evidence of the idea that they want to put all of our crypto into controlled ETFs. More about BlackRock's dystopian tokenization plans in the description. Now, the fifth talking point is that there are lots of fraudsters who will lure you with the promise of gains and then take all of your money. Some would say that there's only so much one can do to protect oneself from fraudsters. There will always be some percentage of investors who fall for these scams, no matter how obvious many of them are. Now, the sixth talking point is easily the most logical, and it's worth repeating in full. Quote, understanding the nature of investing generally, including having an investing plan, and understanding risk tolerance and time horizon, as well as understanding the nature of investing in crypto assets, can be critical to overall and long-term investing success. Couldn't have put it better myself. But alas, of all these talking points, it seems the first will reign supreme, as the authors then provide a breakdown of all of the risks involved in crypto. Market liquidity risk, volatility risk, counterparty risk, risk of full or partial loss, risk of insufficient disclosures, project risk, operational and cyber risk of fraud, and, ironically, risk of regulation. IOSCO basically just admitted the SEC's crackdowns are a risk. Nice. Now, it's important to note that these risks are legitimate. Market liquidity is one that's often overlooked, particularly when it comes to meme coins. For altcoins, disclosures tend to be a risk, namely when it comes to token allocation and vesting. Even the largest crypto projects are quite opaque about this. The risk of regulation, though, that's a good one, and it's hilarious that the authors noted just before giving a breakdown of what the SEC has been doing to educate retail investors about crypto. They focus on the warning that the SEC gave in March 2023, which was overtly intended to scare retail away. Here's an excerpt from that warning. Quote, investors who deposit funds or crypto assets with a crypto asset securities entity might cease to have legal ownership of those assets and might not be able to get those assets back when they want to. Very educational. Thank you. Now tell us more about those bank bail-ins, more about that in the description. Moving on. Now, the authors also touch on the CFTC's effort to educate retail investors. By the sound of it, the CFTC literally printed out physical flyers that, quote, educators could easily distribute to clients or learners. The CFTC also did direct outreach to select institutions about crypto, including the military, which is odd. But wait, it gets better. The CFTC did some online event that was intended to inform participants about crypto. Only 200 people participated. However, the authors stress that, quote, the event also generated significant social media engagement, with over 660 people viewing an online recording of the event throughout the year. Sorry. However, this pales in comparison to the fear-mongering employed by the regulators in other countries. Take the Monetary Authority of Singapore, which warned retail investors on social media that they could, quote, lose everything they put into cryptocurrency. And part of this educational campaign included this photo, which reads, quote, I lost 3 years' worth of savings overnight, with the subtext, no, it wasn't a scam. What's wild is that the authors note, quote, the tone of the content was deliberately emotive or colloquial rather than authoritative or directive, as market research on public education messaging on crypto assets has shown that youth in Singapore would not respond well to being talked down to. And what's crazy is that the authors also note that the Monetary Authority of Singapore used in-house content creators and, quote, local content creators to spread the FUD. Some of you might recall that a similar tactic was used with social media influencers during the pandemic. Seems to be a precedent. But Singapore's efforts pale in comparison to the clown show that the Canadian province of Quebec put on to educate retail investors about crypto. And as you can hopefully see, the province's regulator had an ad campaign comparing crypto to doing a bike jump over a group of people laying down. Very specific. But this just scratches the surface of what Quebec's regulator did to try and control the narrative around crypto. The authors detail how the authority did everything from SEO optimization to paid ads to get retail investors to notice their crypto doomsday doctrine. They managed to secure a whopping 30,000 clicks. Sorry. But back to the finfluencers. The report's authors also detail how regulatory authorities around the world have been trying to mitigate the influence of independent financial educators such as yours truly. They start with the SEC, which has been warning about celebrity promotion of crypto since 2017. What's scary is that the SEC seems to equate finfluencers with fraudsters, or at least this is how the authors word it. And the same is true for the CFTC, which likewise seems to be conflating finfluencers with scammers on social media. Don't get me wrong, some finfluencers are like that, but not all of them. Now, to refresh your memory, another one of the key talking points around educating retail investors about crypto related to informing them about regulations. Of course, lots of IOSCO's constituents have focused their investor education on securities regulation because, well, they're all securities regulators. The only one worth mentioning is the good old SEC, whose so-called investor alerts have focused on reminding retail investors that cryptos being sold as unregistered securities do not offer protection. In the SEC's defense, one of these protections is disclosures, which, I'll remind you again, are lacking in crypto. And this ties into another key talking point you'll recall, and that's education around crypto investments that do come with the protections and are available to retail investors. Lo and behold, the authors focus on the spot Bitcoin and spot Ethereum ETFs recently approved by the SEC and crypto ETPs in other countries. But it's not enough for TradFi to win by offering crypto exposure. They also need to try and make sure crypto loses. In this context, that's the SEC simultaneously warning retail investors that crypto exchanges are not regulated by the SEC and therefore cannot be trusted. Stick to the ETFs controlled by Wall Street instead. Again, in the SEC's defense, though, there is quite a bit of manipulation in the crypto market, and we talked about it in a recent video linked to over here. But the thing is that this is the case in almost every market. The difference with crypto is that the public transparency of blockchains means it's easy to see when crypto whales are looking to buy or sell in real time. As for the talking points around fraud, the authors provide an equally long list of educational initiatives by IOSCO's constituents. And this might have something to do with the fact that FTX was technically a fraud and it became a poster child for everything wrong with crypto, despite being a relatively small player in the industry. Whatever the case, the SEC and CFTC have both done lots of work to claim that essentially everything about crypto that doesn't come from government-approved sources is fraudulent in some way. A case in point, quote, fraudsters exploit the hype around emerging technologies such as artificial intelligence. I mean, what if they're just trying to get clicks on their videos? The CFTC could use some clickbait with the views they're getting. Sorry. And finally, we have the key talking point that's actually useful for retail investors, and that's having a long-term investment plan. As you might have guessed, the authors don't have much to summarize here, and the only help the SEC has given on that front has been to say things like, pay down your credit card debt. No wonder retail investors are aping into meme coins. And this brings me to the big question, and that's what this means for the crypto market. And the answer is twofold. The first is that IOSCO clearly thinks that retail investors are going to return in a big way, and that this will require lots of education, which, as we've learned, is really just indoctrination. In the conclusion of the report, the authors explicitly call on its constituents to amp up their education efforts on social media during the next crypto bull market. So expect to see Gary and the gang getting ratioed on X a lot more often, assuming of course that Gary is around after the November election. Then again, chances are that you won't even see these educational posts, as regulators seem to think getting 660 views on a video in 1 year counts as going viral. Unless the SEC and CFTC start giving you alpha about the next animal-themed meme coin, it's unlikely you'll ever see them post in your feed. And this relates to the second thing this report means for the crypto market, and that's that we're likely to see the same mindless speculation we've seen in previous cycles. And this is simply because retail investors are lacking quality education about crypto, and it's clear that the authorities don't give it to them. I mean, why would they? Crypto is literally designed to disrupt the government as it functions today. The good news is that it is going to make it fairly easy to identify promising cryptos. Just look for a low price tag, listings on a large exchange, and a strong narrative. And this is what most retail investors will be looking at when they buy. And I'll of course quickly note that memes are not the same as a narrative, just FYI. Also, do keep in mind that these are not the only 3 things to check when researching a crypto. You should pay close attention to the market cap and how much of its supply is in circulation. As a rule of thumb, the lower the market cap, the more it can rally, and the more supply is in circulation, the less selling from insiders. These are the criteria we use to analyze promising small cap cryptos for our Coin Bureau Club members, who get to vote on cryptos we cover. In addition, they get to see which cryptos we hold and which ones we're watching, and even get daily crypto market insights and real-time alpha in our Discord. So if you're interested in becoming a member of the Coin Bureau Club, the link will be in the description. And that's all for today's video. If you learned something new, smash that like button to let us know. And if you want to keep learning about crypto, subscribe to the channel and ping the notification bell as well. And if you want to help others learn about crypto, why don't you share this video with them? Let's help get quality crypto education out there. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, out.